Hello, everyone. My name is Deepak, and I'm with Tax Code Advisors. Today, I'm going to talk to you about health savings account. More importantly, I'm going to do some math for you and show you the numbers, how you can make $1 million, $2 million, even a $3 million HSA account, even if you're starting at age 40. Yes, it is possible, and I'm going to show you today how to do that. So before we dig deeper into it, I think first we should define what HSA is. HSA stands for Health Savings Account. And basically, it's a savings account for medical expenses that can be used completely tax free. Similar to retirement account, just kind of like an IRA account, but you really use it for medical expenses. So pretty good strategy. Now, when I talk to people about tax strategies, usually we like to put money in one of the three buckets. Either it's a taxable bucket, or it's a tax deductible bucket. It could be tax deferred bucket, or it could be tax free bucket. So one of the cool things I like about HSA is it fits perfectly in these three tax free buckets. Basically, it's tax deductible. The day you put the money in, it's completely tax deductible. So if you put, $5,000 into it, you don't pay tax on that money. It's tax deferred, meaning all the growth that happens in the account is completely tax free, so you don't pay any tax on that either. And whenever you retire and you withdraw the funds for medical reasons, that is also tax free. I mean, I don't know of anything else that can give you all three benefits all at once. Tax deduction, tax deferral, and tax free. So because it provides you all of those three benefits all at once, I absolutely run it. Now, before I run numbers as to how I'm going to get it to $1 million IRA, $1 million HSA. Let me give you some basic rules about HSA account. Number one, the contribution limits. The contribution limit for HSA is $4,150 for individuals and $8,300 for married filing jointly. So this is the limit for 2024, but it changes every year. So next year might be something else. So keep an eye out on it. And whatever you put, whether you put 4,000 or 8,000, that is completely tax deductible. So I love that. So before we dig deeper into it, I want you to understand a couple of things. Because if we don't understand how medical deductions work, then we cannot appreciate the benefit HSA brings to us. So, for example, medical expenses. If you take a look at your tax return for this year or last year or even prior returns, you will notice that you have not really taken a deduction for any medical expenses, not for a while. Why is that? Why are we not taking? I mean, we all have medical expenses. We buy stuff on, through pharmacy and treatments and office visits and all kind of medical expenses we have, but we don't see any of that on our tax returns. Why? Well, we don't do that because actually IRS has set up in such a way that if you don't use HSA, then you lose out on all of those deductions. Seriously. So what do I mean by that? So what happens is, by default, if let's say you don't have an HSA account, what happens? Normally, you can deduct medical expenses above 7.5% of your adjusted gross income, of your AGI. Anything below that, you cannot deduct. So let's give you an example. Let's say if you have a $10,000 expense, that means $2,500 you can deduct, but the first $7,500, that's after tax. There's no deduction, no benefit to you. It's just money gone. So basically, if you think of it the other way, HSA bypasses this restriction, meaning it allows you to take tax-free withdrawals for medical expenses from day one. So that's the main reason. It's to now, if IRS comes back and tomorrow says, you know what, we're going to let you write off your medical expenses, HSA is not as effective. It's still effective. There are a lot of other benefits to it, but just not as effective. So please understand that first. That the key idea I'm talking about here is being able to write off that first 7.5%. Now, I use an example of somebody who is $100,000 salary, but what if your AGI was 200,000? I mean, now that means first $15,000 you cannot write off, no matter what. Or if you're in $300,000 income, now it gets even more worse. So you kind of get the idea. The more money you make, more important it is for you to have an HSA. The younger you are, the better it is for you to have an HSA. Uh, so I guess it works in both directions. Okay, so that's the basics of HSA. So let me kind of give you some of the key reasons why I like HSA, and then I'll do the math for you, and I'll show you exactly what do I mean by able to grow $1 million HSA account. So number one, I like it because you get an immediate tax deduction. I mean, why do you go to a tax professional? Because you want to get a tax deduction. You want to reduce your taxes. Well, HSA can do that for you. Number two, which I explained to you earlier, that that first deduction of 7.5% is usually lost if you don't have an HSA. But the HSA, you get rid of that loophole basically, and you're able to write off every single penny that you spend in medical expenses. Third thing I like is whenever the government kind of gives you some sort of benefit, they always put a lot of stipulations. You have to have this documentation, you have to submit this, you've got to keep track of all that. The cool thing I like about HSA is you don't have to do any of that because they give you a debit card, and you can use that debit card to pay any expenses that you might have. And all of those are automatically tracked. So that's I know it's not a big deal for some of you guys, but believe me, the less tracking you have to do, less paperwork you have to do, the better it is for you. So that benefit itself is huge. Another cool thing is, in order to have an HSA account, you have to have a high deductible insurance. If you don't have a high deductible insurance, for example, maybe you are on some sort of a government program, maybe you are on a VA program, for vets, where you don't pay anything for medical, well, you don't qualify for HSA. So in order to have an HSA, you need to have a high deductible plan. And the beauty about high deductible plans is that insurances are typically cheaper. Many times I see them to be 25, even 30% cheaper than high deductible plans. So you save that money. So let's say insurance costs you $10,000 a month. Maybe a high deductible insurance might cost you $7,000 a month. So now you're saving $3,000 every single month, and you can use that money to invest. Idea is, maybe it's $1,000 a month, for example, or versus $700 a month. The dollar amount doesn't matter. The point is that you are able to save more with high deductible insurance plans. Now, how do you find these high deductible insurance plans? Well, those of you guys who are buying it from your company, your HR can always provide that for you. And if you're buying the insurance from a marketplace, then obviously the marketplace will tell you. If you don't have insurance, if you have a small business and you want to set up insurance as a benefit, then definitely reach out to us, and I can connect you with somebody from our team who can help you out with that. So we have that resource in house to take care of that for you. So, like I said, these plans typically have lower rates, so good for you to begin with. So you get a lower rate on insurance. You get tax deduction on every dollar that you put into HSA. That dollar grows tax free, and when you withdraw it, again, it's tax free. Very nice. Now, let's just say some of you guys might already have a problem. They're like, wait a minute, Deepak, but I don't think I'm going to need this funds for medical reason. Well, if you don't, use it as a retirement account. There's nothing stopping you from that. Once you hit age 59 and a half, you can convert this into an IRA, basically. You can use it like an IRA. That means you can withdraw the funds. You do pay tax, you do income tax on it, but you were able to take benefit of that tax deferral for several years. And now you use it any way you like. You just pay tax on it. So no penalties, no other gimmicks. Pretty simple. So another great way for using an HSA. HSAs are very easy to set up. You can have more than one HSA. You can do it from your one employer. You can do it through a bank. You can do it through a brokerage firm. If you want to invest in asset class that is not offered by your company, then you can invest. You can reach out to us. We can help you set up a self-direct IRAs. Self-direct HSAs. That means you can invest in anything you like. For example, some people believe in crypto. Some people believe in real estate, commercial real estate, residential real estate. Some people believe in gold. Some people believe in art auctions and stuff like that. So there's so many things. I mean, even watches. A lot of time people own watches and paintings and all that kind of good stuff. So, but if you go that route, by the way, before you start digging into it, set up a consultation appointment and let's talk a little bit more. in details as to what might be a better way of setting that up, because there are a lot of like little landmines if you don't understand it, that you can easily kind of get into trouble there. Okay, so that's what I would say there. Another cool thing I like about HSA accounts, by the way, is that you can fund your HSA account all the way till April 15th of the next year. So everything that, maybe you have, maybe you just create an HSA account, but you have not funded it. You can put that money into it next year. So let me give you an example. Let's say you go to a doctor, there's a $500 bill, but you create an HSA that has $50 in it. So obviously there's no way you can use that $50 to pay a $500 bill. So next year you can put up to $8,300 and you can take that draw. You're good. No problem there. More importantly, let's say you didn't put any money next year. Let's say 2 years down the road, you put the money in. You can still take a withdrawal for that expense that you had earlier. The only requirement is that you have to have an HSA account. The money can grow and then you can take the draw. So that's the key requirement. Let me see. Anything else I'm missing? I think that I kind of cover all the things I like about HSA. A few things that I don't like is obviously it has to have a high deductible account, like I said. So some of you guys might not fit very well for it. For example, vets typically have it. Some government programs who have good medical programs, they won't be able to really utilize it. You got to have that high deductible plan. Sometimes we can use strategy where maybe one spouse has it from their work and the other spouse get it separately, but that works out sometime. Oftentimes it doesn't, but we got to do the math and see what works. One thing to remember is as long as you have a high deductible plan, you can contribute to HSA, no problem, as long as you're within that contribution limit. So for merit filing jointly, like I said earlier, $8,300, you're good there. However, once you hit age 65, you need to stop contributing. If you continue to contribute after age 65, that would not work. Now all of a sudden you lose your benefits. So you got to stop contributing at age 65. That's the main thing to remember. So as long as you remember some of these things, then you're good. If you or somebody in your family is sick, or maybe they go to doctors too many times, or maybe they're getting a treatment that is very expensive, then maybe HSA might not be a right fit for you. Maybe you need to look into something where you just have a lower deductible. That might be a better option for you. So keep an eye out for it. Just because your HSA is great, it has all bunch of benefit, it might not be the right thing for you. So definitely pay attention to that. Okay. Now, so I think this part is clear. What do you do with tax deduction, right? You put up to $8,300. We already talked about that, and that you can do that every single year. Tax deferral. So let's talk about that. How do you grow money in HSA account? Well, you grow money in HSA account by investing. So there are a lot of different ways to invest, but you got to know how to do that. For example, majority of the time when clients come to me and we're doing a comprehensive consult, if you haven't really done a comprehensive consult before, we look at everything. We look at your HSAs, we look at your IRAs, we look at your 401k, Roth, retirement accounts. We look at your educational accounts. Then maybe you have some kids. We look at your business, side hustles, your W-2 income, your debt, your mortgages, your car payments. We look at your overall financials and trying to find it. How can we optimize it? How can you have a better rate of return? How can you have a better outcome in your golden years? And you can go out. I have created some videos about how do we calculate your financial freedom number. So we do that as well. Maybe I'll put a link below this video as well so you can easily access it. That's what we do in those calls. But one of the key component of that call is what are you doing with your HSA account? Common answer I get is nothing. My employer does it for me. No, your employer doesn't. There's somebody else they have hired who manages that, and they might have some default option, and that's it. There's nothing else they're doing with this account. Most people don't know that they can use their HSA account to buy ETFs, to buy individual stocks. They can use it to buy real estate, crypto. You can even buy cows. You can even buy paintings, you can buy gold, you can buy jewelry, you can buy watches. You can invest in startups. So there are a lot of startups. If you especially if you know if that startup going to be, can you imagine investing in a startup where your investment can be 100x? You know, put $1,000 to convert into $100,000 or $10,000 into $1 million, just like that. You know, uh, that can happen if you are able to do those kind of moves. So how do you do that? You do that through self-directing. So if you want to learn about that, definitely talk to me and I can teach you how to properly do self-direct. So that's how you grow the money. And I wanted to just remind you that oftentimes this piece of puzzle is missing. Nobody's talking to you about that, because what people are always talking about is um, just set up an HSA account and forget about it. So it that's not a good strategy. You're not going to make a lot of money. And the biggest part of HSA accounts, by the way, is they're not looked at as a short term or a long term investment. That means you all your risky stuff, you can do it under HSA account. For example, somebody believes in crypto. Why trade it outside the crypto when it fluctuates so much? Within the HSA, I'm not saying you go buy crypto, but I'm just saying if you believe in crypto, if that's what you're doing anyway and you like it, then why not trade it under your HSA account, so that way you're not dealing with all of this tax problems, right? It's just a better way of doing that kind of trade. Some people like to do small caps. Small caps fluctuate a lot. They can give a lot of good returns, but they fluctuate a lot. Once again, why not do it under an HSA account? That way you don't have to deal with tax problems. So anything that can result in a significant tax, I think it makes sense to do it under your HSA account. Your outcomes will be just so much better. So let's take a look at an example. So let's say somebody's at age 40 and they contribute maximum, which is $8,300 in 2024, and they contribute, and contribution stops at age 65 here. Now, why I say age 65 is because that after 65 you're not allowed to contribute to HSA. However, you can still, if you already have the money, it can still kind of grow tax deferred, and you can still do the withdrawal. The only thing you cannot do is put the new money in. That's the only requirement. Now, if we assume that you're investing that money into some sort of ETF, like total stock market or maybe S&P 500 or something like that, and it earns 10%. Now, one more assumption I made here is that you're going to continue to make HSA contribution till age 65. However, this HSA amount changes a little bit every year. Now, I assume that it will only change by 3%, but it often changes way, way above and beyond that. But I'm going to stick with just 3% as a reasonable number for our calculation. Based on these numbers, you can see at the age 65, we will have about $1.1 million in our HSA account. Now, we can leave this money to grow tax-free for medical reasons, or we can also use the money. So I'm going to make an assumption that from age 65 to 90, you actually start using some of this money. And I'm going to put a number at, let's say you use about 5%, which means, not sorry, 5%, about 4% of this money, which is about 17,378. So you have $1.140 million and you withdraw 17,378. So you still have quite a bit money left in this. Whatever money you have left in, I'm going to assume that it still remains invested, but maybe not as aggressively as 10%. Maybe we move some of it to bonds and some sort of balanced portfolio, or maybe even some sort of fixed income kind of a product. In any case, I assume that that money will grow at 5% at that point, and we will continue to take withdrawals of almost $17,000 every single year, all the way to age 90. So kind of pay attention to this. For 25 years, you put in 8,300. After that, for 25 years, you took out 17,378, meaning almost double what you put in. And at age 90, you still have $2.7 million left that your kids can inherit and use it like an IRA. So amazing benefit. Now, let's say if you want to use a little bit more. So I'm going to leave all the numbers same. And here, only thing I change is that instead of 17,000, we used 26,000. Look at that. We still have $2.1 million left. Now, I'm not assuming that you're putting money in startups or crypto or anything aggressive like that, because these numbers can be very easily twice as big when you do those, or even maybe 10x than those numbers if you do the right way. But I'm just assuming if you are invested in a general market. What if we take even more? Take a look. I increase the number from 26 to 35,000. What happens then? Number is still well over $1 million, almost million and a half. You took out $35,000. You remember you put $8,000 and you're taking out 35,000. So just to kind of give you a comparison, that's almost five times what you put in. You see, five times what you put in, and you still have $1.5 million for somebody to inherit, or if you want to make a charity or something like that. So amazing strategy. Even if I take out even more, let's say I can even take out 50,000, I'll still have some money left over. Not a whole lot, maybe a couple $100,000 left over for somebody to inherit. So you can see how big of an impact HSA can have during your retirement years. So I would not leave this strategy out from my books. I will try to learn more about it. I'll try to implement it. I will try to do things that can produce better results. Now, I know some of you guys are super smart watching it, and you're probably going like, well, wait a minute, Deepak, there's one problem. The problem is that you're from age 40 to 65, you're not taking anything out. And you're absolutely right. That's the catch, right? Meaning, ideally speaking, you should be really setting these plans up in your 20s, because if you set it up in 20s, by the time you hit 40s and 50s, you have a nice nest egg and you can use that money in those years. That way, any other contribution continue to grow for you. But if you don't have anything, if you start at age 40, then you cannot touch the money. If you touch the money, then it's not going to grow as much. So that, you're absolutely right. That is the most important part of this strategy. So I wish more younger people come to us for consultation and learn about all this stuff earlier. And so they're able to take advantage, but unfortunately they don't. Most people come to us when in their 40s and 50s, or when they're thinking about starting a business, or they have some sort of major tax problem like capital gains or crypto or something else that might be going on in their life. But I think we have there's so much we can do if somebody at a younger age comes and learn about all these strategies. So that's my 2 cents on HSA. I would love to hear from you. What are your thoughts? What are your questions? If you are involved in some sort of side hustle, in some sort of business, then let's talk. Let me see how I can help you improve your bottom line just by making little tweaks in everything you do financially. All right. So thank you so much. If you want to get hold of me, you have a few different ways. Number one, you can just go to taxcodeadvisors.com, set up a free discovery call. That's one. We don't talk about taxes. We don't talk about any strategies, but I get to know you. You get to know me. That's the purpose of discovery call. And the second step is to do either do consultation call. Those are hourly, or you can set up a comprehensive consult, which is, we talk about everything basically. That's done over a few days. And like I said, as part of comprehensive consult, you always get access to all kind of financial training videos that I do throughout the year. So you get all of that access for absolutely free. I talk about how to grow your business, how to set up a side hustle, how to deal with some marketing challenges, some of the tax challenges. Basically, how do you build a successful business? That's the purpose of those calls. So anyhow, thank you so much for watching this video today. If you have any questions about HSA, just leave it in a comment and I'll try to answer that for you. Thank you.